good evening. Welcome to a very special edition of the Money Show, where we are full-fledgedly celebrating ET Now's 10th anniversary. It's all about you, our viewers. It always has been about you, our viewers. But today, we're celebrating the power of 10. And for that reason, it's a very special episode, because we're going to be giving you not one, not two, but 10 wealth creation ideas. And these are not just any wealth creation ideas. They are day-to-day financial tips and financial hacks that I bet maybe some of you may not be knowing about all of them. So let's kickstart the show then. We have our very first financial trick coming up for you right on your screens. And we thought, let's start off with a no-brainer. One wealth creation idea that we at ET now have been advocating right from eons is investing in an SIP. Here's an example of a typical Franklin Templeton SIP. 10 years ago, if you guys had put in 10,000 rupees per month, your total investment would have been 1,20,000 rupees for an entire year. The latest value of the same is 2,08,000 rupees. A no-brainer. Your absolute returns are 74%. A clear-cut case of what a simple wealth creation case is, and that is investing in a SIP, a systematic investment plan which you invest in every month, something as little as 500 rupees. It's a great way to save your money. It's a great way to put it aside for your future, and of course, not to mention, a great way to multiply your wealth. However, do remember, this one does not come risk-free. In fact, here's a slew of experts from the mutual fund industry advocating SIPs.
See, SIP is something, the systematic investment plan, where the investors can put money as they normally used to putting money in the recurring saving deposit of a bank. And while you do that, one, you don't think about whether you are making money or whether it gives you the return that you are expecting, but you keep investing on a continuous basis. The market is something, when you invest in the market, equity market, the market go ups and downs, but at the end of the day, you see actually the index touching new high after every 1.5 to 2 years, and therefore it gives you the return benefit for the longer term. So SIP is something, very fact that you keep investing every month at every level of the market, and also helps you, or rather force you to stay on the course till your achievements are made, which essentially means 10 years and 15 years and 20 years period. That kind of accumulation of investment through the SIP, and the very fact that you stay on course in the market for a long period of time, it helps you create the wealth. And most of the Indian investors are used to investing in for that matter insurance, and then invariably you pay your premium on the due date. You don't want to actually miss the payment that would likely to get accrued for you at the end of your period of life of the policy. The same way, the SIP also, I think, if you have a similar discipline, it helps in creating wealth over a long period of time. That's, I think, the beauty of SIP. And second is the power of compounding, which is nothing but in a common language names, we call it as a cumulative return that one can get. Is actually in some sense the power of compounding is very high, and that, I think, comes only if you stay on course for long. And second, in an SIP,
I think it's a great way of investing. For an SIP investor, the one thing is there is a comfort that you have to invest a sum of money every month. You are, as an investor, able to weed out the volatility, because your investments are at different points of time, at different levels of market, and because of this you don't get hassled by the short-term volatility. It encourages long-term investment, and we have seen the fruits of SIP over the last 10-15 years. And I would sincerely urge the retail investors, who don't want to get hassled with volatility and who can't track the market on a day-to-day basis, that SIP is the best way of creating wealth by investing in Indian equities.
Well, yes, an SIP is the best way of creating wealth. That's well established. But how should you choose an SIP? What are the different parameters under which one must tick the right boxes and create an SIP, or rather create a portfolio that would be best for them to generate wealth? Well, there are two important parameters: direct and growth. These are the two options that the mutual fund industry just does offer you. So which one is more efficient? Which one gives better returns? Well, if you do take the dividend option, it is a bit more inefficient because of the fact that you do have a taxation component that does kick in if you do get your dividends, and not to mention the returns as well are a tad bit lower. However, if you take the growth plan, it means you will not get that regular flow of income in terms of dividend, but you won't be taxed either, and not to mention, of course, you will be taxed only if your gains exceed 1 lakh rupees and if it's a long-term capital gain. For short-term capital gain, you will be taxed at 15%. But net-net, a growth plan is always more tax efficient, and of course, since the fund manager will be reinvesting that money back into the fund, the return potential as well is better. Mr. P.V. Subramaniam is someone we caught up with. He's a personal finance expert. Listen in to why he advocates betting on a growth plan always in the mutual fund pockets.
So when people invest, they normally do not know the difference between putting money in a dividend plan or a growth plan. Today, if you're doing a direct investment and you're not don't have an advisor to tell you what to do, then it's very confusing because the way you're filling up the form, there is direct, there is dividend reinvestment. So which one should you choose? You should never ever choose the dividend plan. You should always choose the growth plan. Even if you want regular income, choose the growth plan. The growth plan will keep growing, and it will not disturb you. It will not give you 40,000 rupees, 50,000 rupees once in a while and you wonder what to do. Whenever you need money, say 15, 20, 30 years later, at that time you can do a systematic withdrawal. So never ever opt for a dividend plan. It is very inefficient, and last year the government has made it even worse by levying a 10% tax on that. So never ever touch the dividend plan. Always take the growth plan. Whenever you want money, do a systematic withdrawal. That's the way to go to create wealth.
Well, it's not always about mutual funds and SIPs. Here's a very simple hack. Did you know that your parents, who if they are in the senior citizens bracket, are actually eligible for a higher interest scheme? Yes, the government does have a senior citizens savings scheme that does offer a much more attractive interest rate. And of course, not to mention, if your senior citizen parents are indeed senior citizens, they will also be eligible to enjoy a lower tax bracket. So not only do you get a higher interest rate, you also get a lower tax liability. So doesn't it make more sense for the family as a whole that if you do invest in the name of your senior citizen parents and enjoy the double advantage? So that's TMS tip number 3. Tip number 4 meantime, and this one is a very interesting one. Instead of putting your money in a regular savings account where you will get maybe a 3.5 to 4% interest rate, and of course not to mention you will be taxed at 30%, net return only at 2.5, 2.8, why not use the same money and put it in a liquid fund? Look at the sort of returns you get in a liquid fund, 7 to 9%, which puts the net return after tax at 5 to 6%. What exactly is this sorcery? Well, we have with us Harshvardhan Roongta of Roongta Securities right here in the studio. Harsh, tell us, what is it that makes liquid funds so attractive?
So well, Mumina, it's a very simple thing. It's you've got money lying in your savings bank account with a simple purpose, and your objective is that you might need this money at any point in time. So why not you invest this money out of your bank savings bank account? As you rightly said, a savings bank account will give about 4% interest. You can park this money in a liquid fund. A liquid fund by design is meant for a temporary parking of money, wherein the returns are generated for the number of days that you are invested, and the kind of returns that we are expecting from this product is between 7 and 9%. So yes, you can temporarily park your money there, redeem it the day you want it, and you will get it T+1 if you give a redemption request before 3 o'clock.
Well, there you have it. Need your funds urgently, and hence you've parked it in a savings account. But hey, why not do the same? Put it in a liquid funds account and you will still get your money on a need basis. Well, moving on to tip number, well, I've lost count, but I think it's tip number 5, and that is review your credit score. This one is actually for all the people out there who have a home loan, a car loan, or actually any longer term loan. When you have taken the loan initially, your circumstances and situation may be different. For example, you may be in a particular type of job, earning a particular kind of income. However, fast forward 4 years later and you have climbed the corporate ladder, you are working in a bigger company, hey, these situations can change your interest rate. So call up your bank manager or your loan manager, ask him that are you now eligible to pay a lower interest rate? You may be able to be able to pay a lower interest rate if in case you do get married, if you are hired by a bigger employer, if you are earning a higher income, or if you own an asset. That certainly does stand potential to change your credit score. Well, let's move on then and bring on board the next tip that we on The Money Show have for you, and that is a very interesting one. Churning off your profits, or essentially reaping back the capital gains. Remember that in Budget 2018, Mr. Arun Jaitley had some not so good news for all the long-term investors in the equity markets, and that is, if your profits are more than 1 lakh rupees, you're going to have to pay 10% income tax. Well, fret not, here is a way on how you can manage your tax expenses. If in case on a particular investment you are earning approximately 99,000 rupees of gains, book your profits, sell your shares, and if you are still convinced about the long-term story of the stock, simply buy it the next day. You do get saved from paying long-term capital gains, and at the same time you continue to holding on to your investment. The only exception is that instead of leaving your gains unrealized, you've simply realized it, and not to mention not paid tax on it. Listen in to Karan Batra, tax expert and blogger, on what he had to say about the same.
Another way to maximize your wealth is by saving out on taxes. And one way to save out on tax, I am here referring to the recently introduced capital gain tax on sale of shares and mutual funds. So what essentially happens is, if you have shares or mutual funds which have been held for more than 1 year, 10% tax is levied. However, there is an exemption of 1 lakh rupees. I'll explain how you can use this. Say for example, you make an investment and over a period of 10 years, you earn 10 lakh rupees as capital gains. 1 lakh rupees is exempt and balance 9 lakhs get taxable. On this 9 lakhs, you have to pay 10% of tax. A better way to save this tax and show it is by showing 1 lakh rupees of gains every year rather than showing 10 lakhs in a single year. So by showing 1 lakh rupees of gains every year, what you are able to do is, you are able to disclose income which is exempt, thereby no tax is payable. How you do this is by converting your unrealized gains to realized gains. So say for example, you have unrealized gains of 1 lakh rupees and there is no realized gains. What you do is you sell that stock or redeem that mutual fund and then rebuy it. By doing this, what you are able to do is you are able to book your profits, number one. Number two, if you think that the stock is good, you believe in the growth story, you are able to reinvest at a higher rate. This is just a notional book entry. There is no profit or loss which has arisen, but in the books of accounts, a profit has arisen on which no tax is payable. So if you
Well, moving on, there are more products out there, and a very simple one, a plain vanilla term insurance. Pay one time and of course you can secure the future of all your loved ones. Not to mention, of course, it also allays any sort of fears of any upcoming liabilities. For example, if you have taken a home loan and God forbid something happens to you, your spouse or your partner does not need to worry about how he or she is going to pay off that term loan, or rather pay off the term loan, because hey, you've taken out a term insurance. It's a very simple hack, and it's something that every responsible individual must take. Well, tip number 8, and hey, you're going to take an insurance, but might as well again choose it the right way. What's a multi-year insurance? Well, it's a simple hack in which you have to pay your premium in a specified timetable, as opposed to a single-year insurance. A multi-year insurance essentially means that you pay a lesser premium. Take it as a discount for early bird premium payment. It's almost a 20 to 40% discount compared to single insurance payment, and not to mention 40% NCB versus a 35% NCB in a single year policy. And don't forget, money saved is money earned. Tip number 9 then, an arbitrage funds. Well, it certainly sounds like a fancy name. Well, it is a bit fancy and complicated, but it's essentially a simple mutual fund product that does give you better returns, 7% versus say a fixed deposit 7 to 8%. That's not better. The better part is the taxation treatment. If you are in the highest tax bracket, you're going to be charged 30% on fixed deposit. And look at the net tax returns, 67% in arbitrage. That's a nice 100 basis points higher than fixed deposits. Listen in to what Karan Batra had to say about the tax efficiency that arbitrage funds do enjoy.
Another way to maximize your wealth is to save out on taxes which you pay on your regular interest income. So if you're investing in a fixed deposit, you're earning around 7%. Now there's a comparable investment, that is arbitrage funds, and the direct arbitrage funds are also returning around 7%. Now the good thing about the direct funds is that one, the return is higher, which in this case is comparable. Two, the taxation part. So arbitrage funds are treated same as equity funds, and if you hold them for more than 1 year, there's 10% tax, and if you hold them for less than 1 year, there's 15% tax. Whereas on fixed deposit, you are taxed as per your slab rates, which in some cases may be as high as 20% or 30%. Another advantage which arbitrage funds give you is that in case of premature, in case you withdraw the funds, they may not levy a penalty or premature charges, whereas in case of fixed deposits, if you premature them, there is a 0.5% penalty which you end up paying. Therefore, in most cases, arbitrage funds are returning more, the direct component of the arbitrage funds are returning more as compared to the fixed deposits, and I am here referring to the post-tax returns. The pre-tax returns are almost comparable, but the post-tax returns, arbitrage funds have an upper hand.
And finally, tip number 10. Remember, wealth is also about attitude. So you need to change your habits. For giving you some inspiration, we have caught up with some frugal, effective habits of most wealthy individuals. Look at Warren Buffett, CEO of Berkshire Hathaway, the most successful investor. Net worth of $68 billion, but he still lives in the same home that he bought way back in 1958. Another man, that is Mark Zuckerberg, still drives a manual transmission Volkswagen hatchback, and hey, don't say he can't afford it, because his net worth is more than $50 billion. The founder of IKEA, Ingvar Kamprad, flies economy and often rides the bus. Talk about frugal transportation, but hey, that too can go a long way in saving you money. Our very own Azim Premji, the chairman of Wipro, drives second-hand cars and reminds employees to turn off lights at the office. Not only is it good to save money, but it also does save the environment. And finally, here is Charlie Ergon, the chairman of Dish Network, still packs a brown bag lunchbox every day. So think about that the next time you want to order from Swiggy. There you have it. Very simple, very effective financial tips, financial tricks that we hope will help you the next time you're sitting down to make your financial plan. We will take a very quick break right here on the show, but Harshvardhan Roongta will be joining us after this very short break to talk to us about how to approach wealth in a more holistic fashion. Stay tuned. You're watching a very special edition of the Money Show right here on ET now, where we are celebrating 10 years of excellence. And I have with me Harshvardhan Roongta of Roongta Securities right here on the show. Harsh, you heard out the 10 tips. Did we miss out anything?
Oh, well, not really. I think you've covered everything in an elaborate manner. By and large, yes, it does take care of all aspects, not only investments, but it does also take care of habits. I think you've covered it very well.
Okay. We've got quite a few common questions that are asked when one looks at the entire financial planning perspective, and one very common one is debt. I think the word, at least in India, does bring about a lot of fear, because Indians are in the habit of essentially saving. We are primarily still an economy that has most of it locked away in lockers or in savings or with the housewives of the country. But a common question is, how much debt is too much? To what extent should individuals essentially finance their purchases through debt?
So, well, in fact, we are a very conservative environment, and that's how we've been brought up with. But what you see now is the EMI culture. You can avail finance for the smallest of things, and you pay it over EMIs, and you can have the biggest of purchases that you make, and they can pay EMIs for that as well. So what is this leading to is people spending more than what they require. They sometimes are buying things which are not required, which could be deferred otherwise, or instant gratification. You're simply buying it today because it's available on EMI. So what essentially a person should do, or a household should do, is segregate your expenses under two different categories. One is needs and one is wants. So the moment you're able to segregate your requirements, whatever you're going to purchase, just ask yourself, do I need this or do I want this? So I'll give you a small example. In today's times in life, every member of your family is required to have a personal mobile phone, because you want to keep in touch with them. They're outside somewhere, you want to contact them instantly. So anybody and everybody will need to be contacted and reached to. So everybody needs a mobile phone. So that's the need. But if you say every individual in my family wants an iPhone, which is 50,000 worth and above, there's a disconnect. So you need a phone, but you want an iPhone. So there is where then you start going out of your means and you start buying something which is beyond your means. So that should be avoided, and you can't then equate it to say that I have an EMI scheme wherein I can buy something is available to me for say 2,000 rupees a month EMI. So we don't want to get into all that. So try and curtail that part. So I think the moment you're able to segregate whether I need this or I want this, then you will be able to make more prudent investment and buying decisions rather.
I think Harsh, maybe 10, 12 years ago, if you were asked this question, someone would have been like, no, a phone is just a want, it's not a need. But look at the way things have changed now. The other question is, this is with respect to actually home ownership. Now, again, a very contentious issue, and in India, with the culture of living with your parents, it's something that sort of stays away because you're living in your ancestral property, you're living in your father's property, so you're okay. However, the question has arisen that maybe now one should consider just simply living on rent over purchasing a home, because just to give you a simple example, you do have your rental yields in India which are still very low comparatively compared to US or Canada or UK. You will spend 30-40 years making a home purchase, and in that much time you will be living on rental. So how do you essentially make that decision?
So you're right. I mean, if you just put numbers, if we were to simply do calculations and just try and derive a solution or an answer, saying that am I better off buying a property, or am I better off living in the same property on rent? So all calculations that you do will point at one simple answer, and that is that rent. Of course, you don't need to buy the property. You should stay in that property on rent, because there is no financial calculations that justifies buying a property. Now, however, this is the practical aspect of the entire equation that we're talking about. Remove the practical aspect and come to the emotional part of it. I mean, not owning a house at all is not looked up with respect. I mean, you may be very successful, but if you don't have a house and you continuously live all throughout your life on rent, it's not really looked at well. I mean, we've had certain queries come to us on shows like these, wherein one person said, in my community, no family will ever give their daughter to me if I don't even have a house. Now, how do you argue on that point? I mean, it's a completely emotional side. So there are possibilities that a boy may not get married if he does not have a house. Now, whatever practical calculations that you put in to say that it's not worth buying a house, there is nothing that you can do about it. Yeah. So, what we just come to conclusion with is that if it's a first house that you're buying for yourself, for your own self-occupation, then of course don't get into calculations. Simply go and buy it. And then even if it requires 20 or 30 years of EMI payment, there is no solution. Yeah. Okay, and on the other hand, if it's a second house which you're buying purely from an investment purpose, then equate it purely on those investment parameters, which is liquidity, taxability, appreciation, risks. So put all those parameters if the intent to buy it is for investment.
Okay, Harsh, very quickly, one financial advice you received which was really worth it.
So well, I am grown in a conservative Marwari family, so we've always been talking about money. So my parents just gave me one simple advice. He said, enjoy your money, but live within your means. So do everything which is available. Don't try and borrow unnecessarily, like those needs and wants. Yeah. But then enjoy whatever you have today, but well within your means. Do not exceed them.
Enjoy your money. We're not saying be frugal, enjoy your money, but live with it your means. Well, on that note, Harsh, thank you so much for joining in. We're completely out of time, ladies and gentlemen. I hope you've enjoyed this very special edition of The Money Show. Thank you for watching.